Welcome. I'm Joel Kundick, a financial advisor in Savant's McLean, Virginia office. My mission today, and I've already chosen to accept it, is to talk to you about the big tax surprise and then to give you 10 strategies to avoid it in under 2 minutes per strategy. We'll see how successful I can be there. So I wanted to tell you that tax planning is a mindset. We often try to think of it only at March or even just in April. And that's oftentimes how we get ourselves into trouble. We think that really we're going to fix everything from a tax perspective by just giving it the minimum amount of time per year to focus on it. When really tax planning is a mindset, it takes place throughout the year. The worst time to talk to our tax professional about strategies to mitigate taxes due is in April, when they're up to their neck in tax returns. A much better idea would be to think about taxes throughout the year yourself and to engage your tax preparer, or even just yourself if you're your own tax preparer, in August, July, November, even a lull in the year where you have a good idea of where the year is heading, but you're not too late to make some changes to impact it. So how do you avoid a big tax surprise? Well, tax surprises don't usually happen from our paychecks, right? We're usually paid in a regular amount each month, each quarter, and we are paid a similar amount to what we were paid last year. So as long as we didn't owe a lot of taxes the prior year and nothing has changed, we're not likely to have a huge change in our taxes this year, barring a major change to tax law. But oftentimes we have unique things happen for ourselves within a year. So watch for unusual events. If you sell a home, if you get a promotion, if you change careers, if a spouse starts working, if you become self-employed, a very large bonus, selling a business, or unusually high stock compensation. These are all things to prime your mind to think about what could be different this year from other years. If any of those things have happened or are likely to happen in the current year, you would want to schedule a time to meet with your preparer in the fall. Bring with you your year-to-date pay stubs so the preparer can see all your year-to-date tax withholdings, and then the list of whatever has changed during the year. Have you had a child? Have you gotten divorced? Have you received an inheritance? And then also make sure you've talked with your financial advisor in advance, so you have a good idea of what might be lurking around the corner with realized gains, dividends, unusual income distributions from investments that you hold. Your advisor hopefully is looking to be tax efficient in their approach, to minimize taxes each year to get you better overall long-time returns. But if you have a big tax surprise, what are 10 things that you can do to mitigate those surprises? I'm going to divide my recommendations into above the line strategies and below the line strategies. Above the line just means they reduce our income. We like strategies that reduce income because a lot of benefits are keyed off of income. State income taxes are keyed off of federal adjusted gross income. So anything we can do to reduce above the line can have ripple effects throughout our taxes. In many or most states that have income tax regimes, they link themselves to the federal income tax return. So AGI, adjusted gross income, is a very important principle that we're trying to impact. We look at this slide, there's telling us about two tax regimes that work somewhat together. So these are 2022 tax rates expressed for income, ordinary income, so paychecks on the left, and then long-term capital gains and qualified dividends on the right. Taxable income can be subject to 0% tax if you earn less than $12,000. But if you get up above there and up to $20,000 as a married filing joint, it can be only 10%. It makes a large jump at the $83,000 level to where it jumps from 12% up to 22%. And the next significant inflection point is at the $340,000 level, where it jumps from 24 to 32%. So there's a lot we want to do if we're close to those inflection points to either bring us below, if possible, or minimize how much is above those points. The long-term capital gains rates are different, but somewhat keyed off of the income rates. So you can see here, if I earn less than $83,000 in a year, I would owe perhaps 0% in my capital gains. So sometimes I'm not just looking in tax surprises for unusually high income years, I'm looking for unusually low income years where I've decided to take a sabbatical, a spouse has decided to not work, earn a paycheck for a period of time. I'm looking for opportunities there, maybe to move income into a tax year. Overall, I'd tell you, don't let the tax tail wag the life dog. Never do we want to have taxes be the number one driver behind an activity. We want to look for what we're already doing to see if we can impact. So strategy number one, take advantage of the preferential capital gain and dividend tax rates when they're available to you. Strategy number two is to watch out for the net investment income tax. In 2012, the Affordable Care Act was put in place and a 3.8% surtax was imposed to help fund Medicare. The way I think of it, the technical language is in the slide, but the way I think of it as investment income layers on top of ordinary wage income. So all of your earned income, if you're retiree, pensions, Social Security, IRA distributions, all of that is considered ordinary income and is the way that we look at tax brackets first. But then if I have investment income, capital gains, dividends, things like that, that sits on top of my ordinary income. If I get above $200,000 single or $250,000 of income married filing jointly, I'm going to be exposed to that extra 3.8% Medicare surtax or the net investment income tax. What are the types of income that are exposed to this? I already said capital gains and dividends, passive income where you're not actively participating in a private investment, non-qualified annuity payments, rental and royalty income. Those are the types of income I want to be mindful about. And again, what I'd like to do is spread those forms of income over multiple years. I've worked with clients who have highly concentrated positions in individual stocks that they're trying to get out of over time. If we can build a strategy to realize some of those gains over a series of years, we can avoid that 3.8% Medicare surtax or the net investment income tax. Strategy number three, this is going to be one of those accelerating income strategies. Consider a Roth conversion. So there's two tax methods for saving in a tax preferred manner for retirement. One is a traditional IRA, the other is a Roth IRA. Parallel strategies exist as employees. We have traditional 401ks or 403bs. We also have Roth 401ks or 403bs. The thumbnail answer I'll give you on which should I contribute to is, well, it depends. Is my income lower now than I expect it to be in the future? If that's the case, maybe I want to use a Roth methodology. If I expect my income to be lower in the future, higher now, I probably want to use the traditional strategy to defer income, get a tax benefit this year and defer income into the future. Qualified distributions from a Roth IRA are tax-free. That means you don't have to pay any income taxes either on what you contributed to it or the growth. The disadvantage is you didn't get a tax deduction in the year that you funded it. But if I have clients who are in unusually low income years, and I think particularly of this, the most valuable time is post-retirement, pre-required minimum distribution age of 72. Let's say I retire at 62 and I've got 10 years where I'm not going to be receiving as much income and I don't have to take money out of my traditional IRA or 401k yet. I can do a Roth IRA conversion, accelerate income into the current year, take advantage of that 10 to 12% ordinary income bracket, and get money over into something that can grow from there to be tax-free. So I'm thinking of income tax over a period of years, not just over the present year. If I'm just looking to optimize this year, I just don't want any income. But if I know I have additional income coming in future years, I want to accelerate into the current year. And a Roth IRA conversion is a great way of doing that. Strategy number 4 is to make your portfolio tax efficient. I referenced this earlier, but oftentimes people think that they really just want to grow any investment in their basket at the same pace. And that's just not the case. There's 3 methodologies for saving. Roth, we already talked about. Traditional, we already talked about. And a taxable brokerage account is the third way. Really, of the 3, I'd rather have The Roth grow the most, the taxable account grows somewhere in between, and the traditional grow the least if I have three different buckets. Many of my clients only have one bucket. Everything is in their tax deferred account. And then we're kind of mixing strategies. We're saying, well, let's just grow that as much as we can because that's our retirement vehicle. But if I have multiple strategies to pursue tax efficiency, it's the bullet on here is asset location strategy. I'd want to locate my assets in the best possible tax buckets. My highest growth assets go into my Roth. My lowest growth assets actually go into my traditional IRA or 401k. And then everything else goes in the taxable brokerage account. Another method within the strategy of tax efficient portfolios for high income earners in particular is to use high quality municipal bonds. So if I'm in the 35 or 37% federal income tax bracket, I'm paying a lot of taxes on interest income from bonds. And what I'd rather use if I can is municipal bonds, which are given tax-free preference. So they may earn a lower interest rate, but their tax effective yield is higher than a traditional bond. All right. So that again these are strategies. I'm designing these as thumbnails for you to consider for your personal situation or to talk with your financial and tax advisor about, hey, is this the right solution for me? Strategy number 5, maximize your 401k. Now, when I say that, I already said I don't necessarily want to grow my traditional 401k as my highest growth asset because growth inside of a traditional 401k is all going to be subject to income taxes when I take it out. I can't avoid those taxes even by leaving it to my heirs. If I don't pay the taxes on it, the people I leave my IRA or 401k to are going to have to pay the taxes on it. Well, then what do I mean by maximizing my 401k? The number one benefit of a 401k is the employer match. There's no investment out there I can find for you that gets an automatic 50% or 100% return, except for a contribution to a 401k or other tax preferred retirement plan strategy at work. If you get a match, don't walk away from any of those dollars. That's probably the number one thing I'd like you to come away with from today's webinar. The next best thing about a 401k, though, is that you can income shift with it. So what do I mean by that? Well, I'm saying if I'm in really high income years now and I'm going to be at lower income years in retirement, I would rather move whatever income I can out of this year for taxation and into the future to be taxed then. And what I want to do then is maybe put up to $20,500 if I'm younger than 50 or $27,000 if I'm 50 or over into that 401k plan to income shift. I get a tax deduction this year. I bring that AGI down just like I want to, and I move taxation into my retirement years where hopefully my taxes are going to be lower. Let's look at strategy 6, tax loss harvesting. Lots of people think, I don't want to have losses in my portfolio. Those are a bad thing. Sometimes losses are unavoidable. We look at a year like 2020, March of 2020 was an awful year for stocks. However, there was a way to make some lemonade from those lemons, if you will, by tax loss harvesting. What is this strategy? It's selling investments that are at a loss and at the same time buying a similar but not identical investment. You lock in the loss, you stay invested in markets. What is the benefit of doing that? Well, I am able to avoid up to $3,000 of income by loss harvesting each year. That $3,000 of losses can be offset against my ordinary income. I also am able to shelter gains. So if I had an unusually large sale of home or individual stocks that I hold, and I want to shelter those gains in some way, I can book losses to offset those. Again, with tax loss harvesting, I'm looking at pushing taxes off into the future wherever I can. If I'm not able to use those losses this year, I'm able to carry them forward into the future indefinitely. I can use those as long as I want to shelter gains well into the future. I have clients who booked losses in 2008 that are still sheltering gains they're receiving many years later. The key assumption is that you're going to stay in the market. In no way am I recommending that you get out of markets when you tax loss harvest. You're just selling your primary holding, buying a similar but not equal secondary holding, and locking in the loss. Strategy number 7, donate your IRA to charity. How is this beneficial to me? Well, this is a particular strategy for those who are 70 and a half and older. Once you reach age 70 and a half, you are able to donate up to $100,000 per year directly from your IRA to a charity. And it's able to avoid income taxation altogether. It never enters your tax return. This is a really powerful strategy for those who are already charitably inclined. In no way is it beneficial to someone who wasn't planning to give to charity and says, I want to just take advantage of a tax deduction, because you are losing money from your IRA, right? But if I'm able to donate, let's say $20,000 to a charity that I was already planning on giving to, and I'm in retirement, I'm not getting much of the itemized deductions that used to be beneficial to me, it restores my charitable giving to receive benefit from the first dollar. It never enters my income. I keep my AGI low, and I benefit the charities that I want to help. Those are some of the above the line strategies we can look at. How about some below the line strategies? And what do I mean by below the line? Below the line just means after we figured out what our total income is for the year, the government allows us to take reductions from our income when we're calculating our taxes. The most common below the line deduction you hear about is the standard deduction, okay? And right now, the standard deduction is $25,900 for married couples filing jointly. If you're over 65, then you're able to get an additional $1,400 per person in deduction. So really, these standardized deductions are a lot larger than they used to be in the past. Many retirees are actually not using itemized deductions anymore as a result. Sometimes even in our working years, we aren't. The mortgage tends to be a strong deduction still. Charitable giving does as well. We're limited to $10,000 per year on SALT, or state and local tax deductions. But one of the things we can do to take advantage of this very high threshold on standard deductions is to move deductions into a single tax year, to bunch them and push ourselves over that standard limit. What are the two places we can do this? Well, the number one is charitable giving. If I'm already inclined to give charitably, and I was going to give annually a certain amount, let's say I pair 2 of those years in a single tax year. And sometimes I can just think of it as, hey, it's reaching December. I would normally do my giving in December. I'm going to wait till January this year on my giving. I'm going to take the standard deduction for the current year. I'm going to push charitable giving into January, and I'll double up in the next tax year to push myself up above the standard deduction in the future year. This is a way to recapture some of those itemized deductions that otherwise were lost because of these very high standard deductions. One other place you can do this is with medical and dental procedures. Oftentimes they're emergencies, there's nothing we can do about them, but sometimes they're more elective, like a dental surgery that I can choose to do whatever tax year I want. I'd want to bunch those deductions into a single year to get the maximum benefit of what I can take below the line. Strategy number 9, use appreciated securities in charitable giving. The idea here is if I'm already going to be giving to charity, again, this is not using a new strategy, but something I'm already doing, I'd rather give with appreciated securities than give with cash. And some people will come to me and say, well, I've already got $10,000. I'm just going to write a check to the charity. Why would I want to use appreciated securities? That sounds like it makes things more complex for me. Well, if I can illustrate for you, think of putting $10,000 into your portfolio instead and giving $10,000 of some security that has been appreciating for years in your portfolio. Think about Apple over the last 20 years, or if you've been holding something 40 years that was gifted to you by a parent, Exxon or a McDonald's stock. We will give that to charity. We don't have to pay the realized gains taxes when we give that security. The charity doesn't have to pay it either because it's a nonprofit. So there's more power to me in getting a double taxation benefit. I get the deduction already for my charitable giving, and I avoid a realized gain that was otherwise going to impact my tax return at some point when I sold that investment. The last strategy that I'm going to recommend today, strategy number 10, is to control your charitable deductions with a donor advised fund. I think of this strategy as bunching on steroids, right? We do a lot of bunching into a single year. I think of this as a great strategy, particularly when I've sold a business in a certain year. And I know that I'm going to want to give to charity over the next 10, 15, 20 years. but I also know that my income tax rates are going to be much lower than the 37% tax rate I'm going to pay on all of my income in this current tax year. It used to be that what you would do would be to set up a private foundation. There were all kinds of costs and administrative burdens with setting up a private foundation. You had to choose a mission that you could only limit your giving to that. You had an annual giving requirement. You had an annual tax return that needed to be filed for the foundation. Now, there are entities out there that will allow you to set up what's called a donor advised fund, where it's a placeholder for your charitable giving. You are able to get the tax deduction in the current year, but you use it over the coming years. So you don't have to choose the charity you're giving to right away. Or even if you know the charity you want to give to right away, but you know you want to help them over a period of years, you make the massive contribution to the donor advised fund. You're able to even choose investments inside that fund. You get your full tax deduction this year in the year where your income is super high, and then you're able to use that deduction, those giving, you're able to use the amounts that you've given over a period of years to charities, even though you took the whole deduction in that high income year. Those are the strategies that I thought it would be helpful for you today. Again, my goal was to give you thumbnails to consider and ask more detailed questions to your tax advisor or your financial advisor. Thanks for joining me today. For more information, please look at our website or schedule a complimentary consultation with a Savant advisor.